The biggest gains in the stock market over the past several years have come from artificial intelligence and large technology companies. Investors who position themselves early have enjoyed extraordinary returns, and the excitement surrounding AI has fueled one of the strongest rallies seen in decades. However, history shows that every major investment trend eventually reaches a point where expectations become unrealistic. When valuations climb far beyond what underlying businesses can justify, markets often experience painful corrections. That raises an important question for investors today. If the AI boom eventually turns into an AI bubble and that bubble bursts, where will the next generation of opportunities come from? More importantly, where can investors still find the potential for tenfold or even 100-fold returns while avoiding the biggest risks associated with today's crowded trades? Some experts believe the answer lies in taking a completely different approach from the majority of investors. Instead of chasing the same technology companies that dominate headlines every day, attention may be better directed towards sectors that have been overlooked, underowned, and undervalued for years. These areas not only offer the possibility of protecting capital if technology stocks experience a major decline, but they also present the potential for remarkable long-term growth that has little to do with the AI narrative dominating financial markets today. There is no denying that artificial intelligence represents one of the most significant technological developments of modern times. Many analysts believe humanity is approaching a period when artificial intelligence, robotics, biotechnology, nanotechnology, advanced manufacturing, and space exploration will increasingly work together. As these technologies evolve simultaneously, they could fundamentally reshape industries, economies, and even everyday life in ways that seem almost unimaginable today. The long-term impact could rival or exceed previous industrial revolutions. That does not necessarily mean every company associated with AI is a sound investment. There is an important distinction between believing in the future of technology and believing current stock prices accurately reflect reality. Many experienced investors argue that technological progress and stock market valuations often move in very different directions. A revolutionary technology can absolutely transform the world while still producing enormous losses for investors who buy into the excitement at inflated prices. Some market observers argue that today's enthusiasm surrounding AI has all the characteristics of a historic speculative bubble. Rather than simply describing it as an ordinary bubble, some believe it resembles the kind of financial manias that eventually become famous throughout history. Comparisons have even been made to the tulip mania in 17th century Holland, the Mississippi bubble in France, and the South Sea bubble in England. Those episodes became classic examples of investors allowing excitement, speculation, and unrealistic expectations to overwhelm rational valuation. Some analysts even suggest the current AI investment frenzy could eventually rival the great stock market bubble that preceded the crash of 1929. Whether that prediction proves accurate remains uncertain, but concerns continue to grow that excessive optimism has disconnected many technology valuations from business fundamentals. One reason for those concerns is the rapid increase in speculative activity. Over the past year, margin debt has risen dramatically, indicating that more investors are borrowing money to purchase stocks. History has repeatedly shown that excessive leverage often appears near the later stages of major market bubbles. As more retail investors rush into the same popular investments, optimism becomes widespread, and the belief that prices can only continue moving higher becomes increasingly common. Many analysts warn that these conditions rarely end well for average investors. Although artificial intelligence is expected to transform countless industries over the coming decades, today's stock prices may already reflect expectations that are simply too optimistic to sustain. Another concern involves the growing number of companies promoting themselves as AI businesses despite generating little or no meaningful revenue from artificial intelligence. Countless firms have added AI-related language to earnings calls, investor presentations, and marketing materials. Yet many of these businesses still struggle to produce consistent profits, and in some cases, they have yet to establish sustainable business models. Even massive investments into data centers have become a major focus of debate. Billions of dollars are being poured into building enormous facilities filled with advanced computing equipment. These projects require extraordinary amounts of capital, electricity, cooling systems, networking infrastructure, and specialized hardware. Supporters argue these investments are necessary to power the future of artificial intelligence, while skeptics question whether demand will ultimately justify such enormous spending. Across the United States and other parts of the world, hundreds of large-scale data centers are currently under construction. Many cover dozens of acres and contain vast amounts of sophisticated computing equipment. Yet some market observers continue asking a straightforward question that surprisingly receives very few clear answers. Exactly how will all of these facilities generate returns that justify the unprecedented capital being invested today? Some experts acknowledge that data centers certainly serve important purposes. They process cloud computing workloads, train advanced AI models, support online services, enable scientific research, and power countless digital applications used every day. However, critics argue that a significant portion of computing capacity is increasingly dedicated to collecting enormous amounts of consumer data, advertising optimization, behavioral tracking, and activities that may not produce sufficient long-term economic value relative to the capital invested. From an investment perspective, many analysts argue that businesses without meaningful earnings deserve careful scrutiny, particularly when they trade at exceptionally high valuations. Revenue growth alone cannot justify unlimited stock prices forever. Eventually, investors demand sustainable profits, positive cash flow, and realistic expectations for future returns. Supporters of AI frequently recommend investing not only in artificial intelligence companies themselves, but also in businesses supplying the infrastructure behind the industry. This strategy is often compared to investing in the companies that sold picks and shovels during the California gold rush rather than trying to find gold directly. Semiconductor manufacturers, networking companies, cooling providers, power equipment suppliers, and infrastructure businesses have all benefited enormously from AI-related spending. However, some analysts argue that this approach is not without risk. If spending on data centers eventually slows or proves excessive, companies supplying equipment to those projects could also experience substantial declines. In many ways, these businesses form part of the same investment chain. If demand weakens at one end, the effects can quickly spread throughout the entire ecosystem. Rather than concentrating portfolios in sectors already attracting enormous investor attention, some experts believe opportunities may exist in areas almost completely ignored by today's market. These sectors receive little media coverage, attract relatively few investors, and often trade at valuations far below those of high-profile technology companies. According to this more contrarian perspective, the strongest opportunities over the next decade may not come from chasing the most popular stocks, but from identifying essential industries that continue supplying the raw materials modern civilization depends upon every single day. Commodities, natural resources, and energy remain the foundation upon which every advanced economy operates. Regardless of how sophisticated artificial intelligence becomes, factories still require electricity, transportation still requires fuel, agriculture still requires fertilizer, and manufacturing still depends on metals, minerals, and other physical resources. Many analysts believe that while investors have become obsessed with software, algorithms, and digital platforms, they have largely forgotten the industries that make modern civilization physically possible. That disconnect may eventually create some of the most attractive investment opportunities available in the market. The first area many experts believe deserves serious attention is the energy sector. Despite providing the foundation for every modern economy, energy companies remain one of the most overlooked parts of today's stock market. Looking back several decades reveals a striking contrast. Around 1980, oil and gas companies represented roughly 20% of the S&P 500. Today, that figure has fallen to only about 4%. Yet the world's dependence on energy has never been greater. Population continues to grow, economies continue to expand, artificial intelligence demands unprecedented computing power, and every one of those developments requires enormous amounts of reliable electricity. While technology companies have attracted most of the investment capital over the past several years, traditional energy producers have quietly generated substantial cash flows. Many oil and gas companies are producing strong earnings while returning significant amounts of capital to shareholders through generous dividend payments. In some cases, dividend yields of 8% to 10% are available, levels that have become increasingly rare across the broader market. Some analysts view healthy dividends as more than simply income. They often represent evidence that a business is producing real cash flow rather than relying on optimistic projections about future growth. Another factor supporting the energy sector involves the changing geopolitical landscape. Global supply chains remain vulnerable to political instability. Military conflicts, sanctions, and disruptions affecting critical shipping routes. Tensions surrounding important energy transportation corridors continue reminding investors that reliable supplies of oil and natural gas cannot be taken for granted. Whenever uncertainty rises, energy markets often respond quickly, creating opportunities for companies with established production and stable reserves. The opportunity extends well beyond traditional oil and gas producers. Many market observers are increasingly optimistic about uranium and the nuclear energy industry. For decades, nuclear power has faced political opposition and public skepticism, despite offering one of the most efficient methods of generating massive amounts of electricity without producing carbon emissions during operation. As electricity demand accelerates, many governments are beginning to reconsider nuclear power as an essential component of future energy systems. Artificial intelligence itself may strengthen the long-term case for nuclear energy. Large-scale AI models require enormous computing resources, and those computers consume tremendous amounts of electricity around the clock. Data centers cannot operate on intermittent power sources alone. They require dependable baseload electricity capable of running continuously regardless of weather conditions. Nuclear power is one of the few technologies capable of delivering that level of reliability while meeting future energy demand. Coal also remains part of the discussion, although it continues generating significant environmental debate. While coal is far less environmentally friendly than nuclear energy, it still provides dependable electricity generation in many parts of the world. Several coal producers, particularly those operating outside the United States, continue generating strong cash flows and paying attractive dividend yields. Supporters argue that until renewable technologies and energy storage become capable of replacing baseload generation entirely, coal will likely remain part of the global energy mix. Many analysts emphasize that the future of artificial intelligence actually strengthens the investment case for energy rather than weakening it. AI cannot function without electricity. Robotics cannot operate without electricity. Advanced manufacturing cannot expand without electricity. Every new technological breakthrough ultimately depends upon reliable power generation. Whether electricity comes from natural gas, uranium, hydroelectric facilities, or other sources, the underlying energy infrastructure becomes increasingly valuable as global electricity consumption rises. Robotics presents another example of this relationship. Many experts believe humanoid robots and industrial automation will eventually become common across manufacturing, healthcare, logistics, retail, and even households. Artificial intelligence will provide the intelligence behind these machines, but the robots themselves will still require enormous amounts of energy to manufacture, charge, operate, and maintain. In other words, every technological revolution still rests upon physical infrastructure that cannot be ignored. Some market observers therefore argue that energy companies currently trade at valuations that fail to reflect their long-term importance. Instead of paying premium prices for companies promising future growth, investors can purchase businesses already generating substantial profits while supplying products the global economy cannot function without. Beyond energy, another sector receiving increasing attention is mining. Mining may not capture public imagination the way artificial intelligence does, but it remains one of civilization's most essential industries. Every smartphone, electric vehicle, computer, solar panel, power plant, transmission line, and manufacturing facility ultimately begins with minerals extracted from the earth. Without mining, modern technology simply would not exist. Despite its importance, mining remains one of the least glamorous industries in the market. Younger generations often show little interest in businesses involving exploration, excavation, and heavy machinery. Technology companies dominate headlines, while mining companies frequently receive little attention from mainstream investors. Some analysts believe this lack of popularity has created attractive valuation opportunities. Among mining industries, gold and silver producers receive particular attention. Gold has served as a store of value for thousands of years and continues playing an important role during periods of economic uncertainty. Central banks around the world have steadily increased gold purchases in recent years, reinforcing its position as a strategic reserve asset. While the metal itself has appreciated significantly, many analysts argue that gold mining companies have failed to keep pace. The economics of gold mining have improved dramatically as higher gold prices combine with relatively stable production costs. Companies capable of extracting gold efficiently are generating cash flows far stronger than many investors realize. Yet despite these improving fundamentals, mining shares often continue trading at valuations that appear inexpensive compared with other industries. Some market observers believe this disconnect exists because many institutional investors remain focused on large-cap technology stocks while largely ignoring commodity producers. If investor sentiment eventually shifts toward resource companies, mining shares could experience substantial appreciation as capital flows back into the sector. Smaller mining companies present an even more interesting opportunity, although they also carry considerably higher risk. Unlike trillion-dollar technology giants, many junior mining companies possess market capitalizations measured in only hundreds of millions, or even tens of millions of dollars. And because of their size, successful discoveries or new production can dramatically increase company valuations over relatively short periods. Some analysts suggest that the greatest gains in mining often occur during commodity bull markets, when rising metal prices coincide with improving investor sentiment. Under those conditions, smaller producers and exploration companies can sometimes outperform larger, more established mining businesses by significant margins. However, experienced investors consistently warn that mining is also one of the most challenging industries in the market. Exploration success remains uncertain, development costs frequently exceed expectations, and operational setbacks are common. Many promising projects never become profitable mines despite years of investment and exploration. For that reason, careful analysis becomes essential. Many experts evaluate mining companies using several key factors. Management quality often ranks first because experienced leadership can determine whether a project succeeds or fails. Executives with proven records of discovering, financing, building, and operating successful mines generally inspire greater confidence than inexperienced management teams. The quality of the underlying property represents another critical consideration. Geology determines whether economically recoverable mineral deposits actually exist. Investors often benefit from understanding reserve estimates, ore grades, production costs, and exploration potential before committing capital. Financing also plays an essential role because mining projects require substantial investment long before generating revenue. Exploration programs, environmental studies, infrastructure construction, equipment purchases, and processing facilities all require significant capital. Companies unable to secure adequate financing frequently struggle regardless of how promising their discoveries appear. Political stability cannot be overlooked either. Mining operations depend heavily upon government permits, taxation policies, environmental regulations, and property rights. Jurisdictions with stable legal systems generally provide greater certainty for long-term investment, while politically unstable regions may expose companies to unexpected regulatory or operational risks. Although mining remains volatile, many analysts argue that volatility should not automatically be confused with permanent risk. When industries become deeply unpopular and valuations fall well below historical norms, periods of pessimism sometimes create the foundation for exceptional long-term investment opportunities. Investors willing to accept short-term price fluctuations may ultimately benefit if commodity cycles turn in their favor. The final area many experts believe deserves close attention is agriculture, one of the most essential yet frequently overlooked sectors of the global economy. Unlike many industries driven by changing consumer preferences or technological trends, agriculture satisfies a need that never disappears. Every person on the planet depends on food, regardless of economic conditions, political changes, or financial market cycles. Several major agricultural commodities trade actively on U.S. futures exchanges, but some experts believe the greatest value currently exists in the grain markets. Corn, soybeans, wheat, and rice account for roughly 60% of the calories consumed worldwide. These crops form the backbone of global food production, supporting billions of people every single day. Despite their critical importance, prices for many of these commodities have remained under pressure, leaving farmers operating at extremely thin profit margins or, in some cases, below the cost of production. History has shown that commodity markets move in cycles. Extended periods of low prices often discourage production because farmers reduce acreage, delay equipment purchases, or cut back on investment. Eventually, lower production meets steady or rising demand, creating conditions that can drive prices significantly higher. Many market observers believe agriculture may be approaching one of those turning points. Global population growth continues increasing demand for food every year. At the same time, unpredictable weather patterns, droughts, floods, geopolitical tensions, transportation disruptions, and rising production costs all create additional pressure on agricultural supply chains. Fertilizer shortages, higher energy costs, and export restrictions have further complicated the outlook for farmers across many regions of the world. For investors seeking exposure without trading futures contracts directly, exchange-traded funds offer a simpler alternative. ETFs focused on corn, wheat, soybeans, and other agricultural commodities allow investors to participate in potential price appreciation while avoiding many of the complexities associated with futures markets. Futures trading can involve leverage, rolling contracts, and significant volatility, making it unsuitable for many individual investors. ETFs provide a more accessible way to gain diversified exposure to agricultural trends. Another factor supporting agriculture is the growing concern surrounding fertilizer supplies. Fertilizer remains one of the most important inputs in modern farming, directly influencing crop yields around the world. Any disruption to global fertilizer production or transportation can reduce agricultural output, placing upward pressure on food prices. Political instability affecting major shipping routes and energy-producing regions has increased concerns about future fertilizer availability, adding another layer of support for agricultural commodities. Many experts argue that these three sectors, energy, mining, and agriculture, share an important characteristic that distinguishes them from many of today's most popular investments. They produce tangible assets that the global economy cannot function without. Oil powers transportation, uranium generates electricity, copper builds electrical infrastructure, gold provides financial security, and grains feed billions of people. Regardless of technological progress, these raw materials remain fundamental to civilization itself. This perspective becomes especially relevant during periods of elevated market risk. Many analysts believe today's investment environment presents challenges unlike those seen in decades. Government debt continues expanding. Central banks face difficult monetary policy decisions. Inflation remains a concern in many economies, and financial markets continue relying heavily on a relatively small number of large technology companies to support major stock indexes. Credit quality also remains an important consideration. Governments around the world continue carrying historically large debt burdens, raising questions about long-term fiscal sustainability. While sovereign defaults remain relatively uncommon among developed nations, expanding debt levels can still influence currency values, inflation expectations, and investor confidence. For these reasons, many experts increasingly focus on tangible assets rather than purely financial assets. Commodities cannot be printed by central banks, and their value often reflects real-world supply and demand rather than monetary policy alone. When production falls below consumption, prices tend to adjust accordingly regardless of conditions in financial markets. That does not mean commodity investing is free of risk. Prices can remain depressed for extended periods, geopolitical developments can rapidly change market dynamics, and individual companies within commodity sectors face operational challenges unique to their industries. Energy producers must manage fluctuating oil and gas prices. Mining companies confront exploration risk, environmental regulation, and capital-intensive operations. Agricultural markets remain highly sensitive to weather, harvest conditions, and global trade policies. Successful investing therefore requires patience, disciplined research, and realistic expectations. Rather than chasing short-term excitement, many experienced investors focus on identifying sectors where pessimism has become excessive and valuations no longer reflect long-term fundamentals. History repeatedly demonstrates that some of the greatest investment opportunities emerge when public interest is at its lowest. According to many market observers, energy, mining, and agriculture stand out as three areas where that rotation could occur. These industries remain deeply connected to the physical economy, generate products the world cannot function without, and continue trading at valuations many analysts consider attractive relative to their long-term importance. Ultimately, every investor must decide where to allocate capital based on personal objectives, risk tolerance, and careful research. Yet one principle has remained remarkably consistent throughout financial history. The greatest opportunities often appear in places where few people are looking. While much of the market continues focusing almost exclusively on artificial intelligence and high-growth technology, some experts believe the next generation of exceptional investments may emerge from the raw materials that have supported civilization for centuries. Whether through energy, mining, or agriculture, these overlooked sectors may not only provide a measure of protection during periods of market uncertainty, but could also offer the potential for remarkable long-term growth if the next commodity cycle unfolds as many analysts expect. Thanks for watching. Please subscribe. It really helps us.